and I'm delighted to hear you all today. We're looking forward to some interesting discussions. We've got three presenters, starting with our Programme Director, Gail Peterson. Gail, can you hear me?
I can. Thank you. Thank you, Gemma, for the introduction. I want to welcome everyone to this webinar. We are, Alex, do you want to go to the next slide? Thank you. We started the Insights webinar series as a way for our colleagues around the world to really understand and build their capacity in the field of impact investing. And this particular webinar, again, focuses on social and development impact bonds. It's an exciting field. We've got today more than 220 people signed up across the globe to participate in the webinar. SIBs are hot. They're really, it's an exciting, innovative topic. We've got, which was started really in the UK, and Alex and Emilie, who you'll hear from soon, have really been leaders of the social impact bond movement in the UK. However, the fact is SIBs are picking up all over the world, from malaria performance bond in Mozambique to Australia and to the United States and beyond. Latin America is doing innovative work in Brazil, in Chile, in Ecuador. So it's an opportunity for us to really understand begin a conversation, share groundbreaking ideas, really help us build a global community and shape the future of impact investing in the broad field of social finance. Next, Alex. It's always good for you to see what Said Business School looks like in the spring. Said is a business school at Oxford University, is a new, innovative business school. It's creating a world-class community doing remarkable things around social and financial impact. So we want you to see Oxford in the spring without the rain. Next slide, Alex. Again, today is a focus on SIBs and the innovation around how the private sector, public sector, and social service sectors are really working together to find innovative solutions to complex social issues. And we're really being joined today by my colleague Alex Nicholls, who is the faculty director for Oxford Impact Investing. And Alex is the professor of social entrepreneurship. He's, from my perspective, is remarkable and is going to describe the social and developmental bond, impact bond history, status, challenges, and opportunities. We're also joined by Emilie Goodall, who's the director of Project Plus at Bridges Venture. And she's going to talk about practical application for SIBs and how they're being used and what's being learned. And again, our goal is to have you understand the basics. This is an opportunity for us to help you understand where we are in the field and to actually begin the conversation of building, providing questions about how to grow this important tool for the field. So we're going to begin with a conversation about the Oxford Impact Investing Program, which takes place in April of 2016. We'll talk with Alex and Emilie, and then we'll open it up for questions for you. So next steps, Brad Peaston will talk about the program. So this gives you a sense of what the classroom looks like in our Oxford Impact Investing Program. This is cohort number 1, and we have on the, as participants in our webinar today, many of our alums, which we're very happy to have join us, as well as, okay, can't hear, as well as other colleagues. And we've got Gemma, we've got an issue with one of our participants not being able to hear. So I want to make sure that you can all hear me. Alex, next. The community of practice. We have 3 cohorts representing more than 120 students around the world. And this map will show you where your colleagues are from. They're fantastic, and it's very diverse, representing, Alex, I think you have to click through again. There we go. So we're showing the sequence of where our population comes from for our cohort members. And as you can see, we're extremely diverse and have representation from around the world. And that's the kind of experience that the program offers. Alex, we've got one more class to go through. There we go. We've got the green class. This is the last cohort. Fantastic. And I think that as we're growing a community of practice, there are some core elements of things that we take on as a community. One is to really understand this is a nascent field. How do we build it together? How do we talk about the challenges that we're facing? How do we examine the lessons learned and help the field grow? So our objective is to really help you build the capacity of the field, and as a practitioner, and the collective actions of all of us. So next slide. Again, this represents the types of people and the sectors they're from. As you can see, they're very diverse, and we also have a very diverse gender balance. Half or more than half of our students are typically women. Next slide. So here we are. We've got you've got photos of us, of our voices. You can associate images with voice. And again, I'm program director, and I'm pleased that we have so many of you who joined us. And Alex, I'm going to turn it over to you.
Hi. Yes, hi there. Hello, everybody. It's good to be here. I hope you can hear me live from my kitchen, which is probably why it's best not to see me. So I've got about 10 or 12 minutes just to summarize for you work we've been doing at Oxford Side Business School on social impact bonds before handing over to an expert practitioner who's actually doing the real work out there in the field. And the first thing to say, I think, is that social impact bonds are not bonds, but I guess they are social, and they're not bonds because they don't really behave or look like a conventional debt product that we would call a bond. They're probably better seen as quite complicated contracts, arrangements between several parties around a social outcome. I guess, but the key point is that they focus on monetizing and finding a way of creating a financial value for a particular social outcome. And we'll explain that a bit more in a moment. Just a very brief kind of context slide, and this is a kind of vastly oversimplified representation of a lot of history, but I think we can see SIBs, as we'll call them from now on probably, as being part of a long tradition of changing the way the government operates in terms of its delivery of welfare services to its citizens. So going right back to the 1980s, we've seen revolutions and changes in the way that the model of a centralized government-driven welfare services framework for society has been increasingly diversified to include private sector actors and also charities and social enterprises over the years. And some of the kind of buzzwords and phrases on this slide relate to big trends in the changes of the way welfare is delivered. Things like quasi-markets, the introduction of, by breaking down the kind of provider and buyer, purchaser elements of government. So the introduction of a sort of semi-market in the way that things like education and health services are provided. And then really more recently, in the 2000s and beyond, we get a strong focus on what's called payment by results, sometimes called pay for success models. And these are models where the government increasingly, or indeed any purchaser of social outcomes, is looking really just to pay for particular results or outcomes and not just give general grants or contracts to an organization that happens to be in the education or health space. So this kind of move away from more general grants and contracts towards very specific payment for social outcomes is the context in which social impact bonds have emerged. So broadly speaking, it's a slightly complicated slide, this, I suppose, but what it's trying to say is the attraction to government of these models is that you can both provide a service more cheaply and make a saving, and you'd hope deliver it more effectively by having a focus only on social outcomes. So what these two blocks are saying is that a SIV makes sense to the government as part of the contract if they can retain a saving out of the overall current cost to government. So let's imagine that a service costs X amount to deliver as it currently is. A SIV might say that we can deliver the same or better service for a lower overall cost, even including the fact that we need to pay some money to investors, and I'll explain that model in a moment. And even the additional cost of investors would still leave an overall saving to the government, and that's one of the attractions. And I think that the history of SIVs suggests that they've shifted from being probably about a focus on more effective delivery of outcomes when they were first sort of invented in the Labour government period in Britain and first launched in 2010, to a much stronger focus now under kind of a conservative government towards savings of money. So there's a kind of shift in focus there, I guess. So these are kind of some of the drivers or prerequisites of a SIV to be, I think, viable. First of all, it's often the case that SIVs are introduced where there's a failing welfare service that's expensive, so something that's costing a lot of money but not actually delivering very good outcomes. And the first SIV, as we'll see in a minute, was in the field of probationary services for ex-offenders or people who are going to leave short-term imprisonment. This was an area where there were very poor results, so people typically reoffended at a high rate after those kind of services. And the SIV, the first SIV in the world, was introduced to try to make that work better. So it's both a saving of money and an opportunity to have a better, more focused impact, if you like. So you need a measurable social outcome. So SIVs are not going to work in very complicated spaces where you can't measure a particular outcome, because ultimately the return to an investor in these models is based on a set of measures that are reliable and robust in terms of social outcomes, and those map onto financial returns. You need investors who are prepared to put in some money up front, because the key to SIVs really is having a private investor who's prepared to provide cash flow or investment up front into a service, which then later may be paid back by government if outcomes are achieved. And that's the next point about you need an ultimate payer who's prepared to pay the investors back after evidence of success. So there's a bunch of kind of criteria, which means that SIVs are not going to be suitable for every kind of context, and there is a danger perhaps that we're getting a bit carried away with how social impact bonds are the future of all public service delivery around the world, and of course this won't be the case. There are some complicated interventions which won't fit this model very well. So here's a diagram showing you the structure of the social impact bond contract for the first SIV in the world, the one that was begun in 2010 in collaboration with Peterborough Prison for short-term prisoners on probation. And it looks like a complicated picture, I suppose, but it's trying to show you that the key players here are the external investors who provided in tranches of up to a £5 million investment into frontline service providers, who were at least 4, sometimes in fact there were others involved too, existing providers coming together under one umbrella called the One Service. So via an intermediary, they took the investment to create a new set of interventions with prisoners. That was measured, and based on a fairly robust randomized control trial type model, the data was designed to demonstrate whether this intervention reduced reoffending rates for their particular prisoner group against a national control sample. And if that did, according to certain measures, the government and the big lottery fund would then pay back investors according to the results. So it's a key set of arrangements that takes quite a long time to put together. This took several years to put together, this partnership between external investors, government, service providers, and sometimes an intermediary to make it all happen. Hang on. Oh, sorry. So this So this was the one service that was set up here. It was a kind of collaborative, holistic service that brought together for the ex-offenders or the offenders leaving Peterborough Prison a range of probationary services under one roof, and that were connected to each other for the first time to really give these prisoners the best opportunity not to end up straight back in jail when they leave. And they, they learned a lot of important things. For example, very simple things like when a prisoner leaves prison, you really need somebody from the probation service waiting for them at the gate, because if that person isn't there, it's quite likely a local drug dealer or somebody else who's going to encourage them to reoffend will meet them pretty much at the gate. And so they did a lot of learning about how to design a really carefully organized service to reduce reoffending rates that learned from other failures. And one of the key things about SIBS for this organization was that they were no longer being assessed on process, but just on outcomes. And because of that, that allowed the one service to innovate. Because unlike many government contracts, they weren't being told how to deliver their service, they were just being measured on their outcomes. And so speaking to the one service providers, they found this a very liberating approach. So let's just think about the benefits and problems, I guess, of SIBS more generally. Well, there are a lot of upside benefits, particularly for government, at least in principle. And the first and most obvious is that you get, in a SIB model, private funding upfront to fund what would perhaps otherwise be government-funded welfare programs. So this, under conditions of austerity and when governments are telling us they have no money, is a very attractive way of effectively pushing back into future years the cost to a government of a service. Also, it may well allow innovation to scale more quickly by bringing in extra capital. So if these are successful over time, they should also reduce net government spending, though not in every case. This was an assumption, which I think actually, as we'll say in a minute, can be quite hard to realize, but it looks like an attractive option for SIBS. They also may transfer some outcomes risks, so they say if this service fails, that's a risk typically that might be borne by the investor, not by the government. So if a service doesn't deliver its outcomes, as for example happened with the Rikers Island social impact bond in New York City, then it's the investors who lose their money. The government or the other ultimate payer in a SIB often has to pay nothing if it fails. That's very attractive. And there's an argument that SIBs allow money to come in early to provide larger scale interventions, at least in principle, which could exploit something called, what I would call net present social value, meaning early intervention often has larger social value creation over time than kind of drip feeding support. Then there are some kind of sort of second order benefits, I guess you might know. One is that SIBs often bring together service providers, and they bring together typically otherwise unconnected players in the kind of social value space. So, social investors, government ministers, and charity or not-for-profit providers. And SIBs force them to work together and to align their interests around particular social outcomes. And I think that's quite a powerful model to set out more generally in times of wicked problems and so on. SIBs have to have good metrics. So measurement discipline, I think, is an interesting learning from SIBs more generally for the social sector, and a focus, I think, on outcomes, not outputs, is also a key contribution. And over time, it may be that SIBs allow us to see robust data sets for social impact measurement, which can be used in other settings. So SIBs, big kind of externality of SIBs may be to create a really powerful set of metrics and data. And they might also help build the social finance market more generally. But there are real challenges. So realizing real savings, as I said earlier, is a real problem. The government may think it's saving money, but can it actually find that money back in its cash flow somewhere else? For example, if you're reducing reoffending, then saving money may only really be realized when you start closing prisons, because prisons will still run at a similar cost level, kind of irrespective until you get to scale of how many people are actually being incarcerated. So you need to think about whether you realize these or not. There are definite funding distortions in SIBs, and that's where the worry that the external private investor starts having a real influence on how a service is operated. That could be a problem. And the final point is they take a long time to put together. SIBs are very expensive and energy intensive at the moment. You know, each one is a kind of labour of love to be crafted. But you might expect over time that might become less of a problem as we have more off-the-shelf models. Just a couple more slides, then we'll hand over. Probably on this slide, the one I would highlight most is the exit issue. I think SIBs haven't thought through well enough in many cases what happens when the SIB finishes. I mean, they're almost all time limited. Peterborough was supposed to be 7 years. It didn't go 7 years in the end. But thinking through what happens after this round of investment and impact and payback is an important question and not, I think, yet properly understood. And then finally from me, I mean, in terms of the hyperbole around SIBs, it's worth noting that the Peterborough SIB, for various reasons, ended up having to pay out early to its investors. It didn't run to its full term. It didn't look at every cohort of offenders as it had planned. And the Rikers Island SIB ended up not paying back to investors as it had proposed it would. And I think other SIBs around the world are finding, you know, real world problems that challenge the social impact bond model for being a sort of catch-all solution to everything. I think once these models get into practice, there are many issues that emerge that we have to think about. But there's no doubt they're growing, and the interest in them is very high, as Gail said. Okay, so let's hand on to Emilie now to look at much more detailed practical analysis.
Thank you, Alex. Thank you very much, and good morning, good afternoon, everybody, wherever you're dialing in from. It's great to see so much interest in this topic, and thank you to Oxford for inviting me to talk on this topic today. So really I want to step back a little bit, perhaps, and give a bit of context. Firstly, Alex, if you mind moving the slide on, just to give some context to Bridges. So we are a specialist fund manager specialising in sustainable and impact investing. We have a track record, I think it's fair to say, over the last 13 years of investing, of experimentation and of learning, and we've done that in the world of social impact bonds through our own social impact bond fund. So the slide on the left of the slide that you're looking at there, you can get a sense of the 14 social impact bonds that we have backed, all in the UK, which together are delivered by 22 different impact-focused organisations. We've also built on that learning to try and share our insights with the wider market on what we're learning as we progress in this novel model. And we put out an industry report last year looking at all of the operational impact bonds at that point. The report was backed by Bank of America Merrill Lynch, who themselves are investing in social impact bonds in the US. And we wanted to share our learning, but also that of other practitioners involved. And that report is publicly available on our website for those who'd like to read more. But I'm going to focus on what we're learning, primarily in the UK context. In that context, because the use and the purpose of social impact bonds is varying around the world, and you are seeing a great variety in the 50 or so social impact bonds that we see so far. But first, I'm actually going to ask you to forget about social impact bonds, and let's step back and look at the bigger picture of which social impact bonds are a part, because it's an important context to understand in why this model is generating perhaps so much excitement. If you wouldn't mind moving on, Alex. So let's think about let's start with the state and how governments traditionally go about trying to achieve better results. They have three options, essentially. The first is that they deliver the services themselves. And so if you look at the slide here, the state itself can deliver activities. So in the UK, that might be through the National Health Service, through the education system. And they deliver out on the basis of a range of activities to help the population, which may or may not lead to the desired outcomes. Now, in some areas, government is delivering tried and tested activities that turn into measurable outputs and outcomes. In other instances, there maybe isn't so strong evidence as to the outcomes that are being delivered. And you see this variety around the world. You move on to the next slide. The second option in this sort of arsenal of opportunities that commissioners have is that there might be situations where it makes more sense for the commissioner to actually be the customer rather than the provider of the services. And so they commission another entity, in other words, outsource the activities that they want to see delivered. And what's interesting is that they traditionally commission the other entity to deliver the same activities they would have delivered For example, we want you to work with 300 offenders over 3 years, for example, rather than commissioning the outcomes that they actually desire, which might be a reduction in the rate of reoffending. And again, while activities and outputs are tracked as part of contracting arrangements, the outcomes may not be, which is why the arrow is not sort of shaded in that link between activities and outcomes. So that's the second option. If we move to the third option on the next slide, our third and final option is that of outcomes-based commissioning, also known as payment by results or pay for success. And in this case, the state or the government decides to commission outcomes directly instead. The benefit of this is that they also only pay when the outcomes are delivered. So they're not paying for activities that may or may not be successful in delivering the results that they want to see. So if we're starting from that 3 options, this third option, if we go on to the next slide, the decision to commission on an outcomes basis, Alex, if you could shift us to the next slide, actually sparks quite a different series of steps to those that we saw in options 1 and 2 in what you might call more traditional commissioning. And the steps that I've got outlined here, actually, sorry, I think there may have been a bit of delay, Alex, if you go back to the previous slide, perfect, apologies. That there is first you need to do is identify a cohort or a group of people whose lives could be better. Now that might be young people that are at risk of dropping out of school. It could be young people who are at risk of ending up in long-term state care. It could be later down the track who've offended and are at risk of reoffending. Lots of different social issues that could be looked at in this way. The second point here, you have to identify the specific results that you want to see. So if we go back to those young people, maybe staying in school and achieving solid educational results would be the outcome. For the young people at risk of going into care, then staying in a safe environment, either in the home or in an adoptive family, for example. For those at risk of reoffending, the result would be simply that they do not reoffend. Third, you have to put a price on that result. You have to price what you would expect to pay for that result if it was achieved. So what price did you put on a on a child staying in school? Sometimes it's possible to quantify this in terms of the resulting societal cost of the worst outcome, sort of what Alex was pointing to earlier, the cost of the court, the prisons, of somebody reoffending and being incarcerated. Sometimes you can quantify that. In other instances, there isn't as clearly a quantifiable measure, but the exercise of going through can identify the cost to society and think about both the negative costs in the event of that event happening and what you would pay to avoid that. Fourth, you create a contract then which specifies the results for the desired cohort within the desired timescale, including the price you're willing to pay, which may include putting a ceiling on the total amount that commissioner is willing to pay. Fifth, you find a provider to outsource delivery of those results to, who is going to deliver it on your behalf. Sixth, and importantly, you don't then prescribe the activities. Instead, having prescribed the outcomes and the impact you want to see, you enable providers to be flexible in their delivery to deliver the results. And I think Alex was referring to that in terms of the innovation and the flexibility in the delivery that we've seen in the Peterborough model. Seventh, and finally, you ensure at the end that there is an objectively verifiable route to establishing whether those results have actually been achieved, on which you will pay out. And if they're not achieved, you don't pay. The important thing here is that you can replace the word state on this slide with any entity that's buying results. That could be, so it's not just central government, it could be local authority, it could be foundations, individual philanthropists, corporates even. Any entity which is looking to deliver social results. Fundamentally, the same 3 options apply when it comes to addressing social issues, and we're talking about the third in this instance. So if we go on to the next slide now, Alex. If done properly, we're seeing that these distinct steps can really lead to a range of powerful benefits, all of which increase effectiveness, efficiency, or both, and can therefore ultimately lead to better outcomes for the individuals concerned. So it's worth running through each of these with a few concrete examples, particularly since many have been topics of quite heated debate. The first, understanding outcomes. So the Commissioner first has to scrutinise the outcomes, not the outputs that they want to deliver, and decide what measurable metric will signify a successful outcome. So to give you an example, in the UK, the Department for Work and Pensions has a mandate to have stable employment among the UK population in adulthood citizens. So ideally, what they would like to do is prevent people early on from becoming unemployed in the future. So they identify the potential to work with young people in a preventative way while still in school to ensure they don't drop out, that they achieve the educational results and enter the workforce. Now, tracking results of this over their lifetime is unrealistic. So the Department for Work and Pensions decided to use a proxy short-term outcome where there's evidence to suggest that they strongly reflect that path to employment, but over a shorter time frame. So they designed a contract, an outcomes-based contract with the Innovation Fund, which was looking at asking for providers to come forward that could improve attitude towards school among young people, attendance and behaviour, levels of qualifications being achieved with higher payments for higher qualifications, getting a job and keeping it for 6 months. And that's where the outcomes payments would stop. But in addition, the Department for Work and Pensions is actually going to track the individual national insurance number of each of those children on the programme over a longer time frame to see whether those young people actually do remain in employment for a longer time period. So really understanding the outcomes that they want to see and what that's going to result in longer term. They also looked at understanding the costs. So the government has to analyse the current cost of achieving that outcome and the value they're willing to attach to it. So once the value has been established, service providers can compete on price. This can be a really interesting exercise, an instructive exercise, as it forces a reflection on historical costs, future costs, and quantifiable social value, which is not something that is necessarily the common way of both service providers working and certainly commissioners working. The second aspect about investing in prevention, simply the fact that you pay later, means you don't have to divert funds from tried and tested critical services, emergency services, which is of course very politically difficult, in order to experiment with preventative measures. So this is enabling commissioners a way to experiment with something earlier on without diverting much needed resource from existing crisis situations. It also has helped integrate services in some instances. So another UK example, the Youth Engagement Fund, is helping disadvantaged young people aged 14 to 17 to participate and succeed in educational training. This should improve their employability, again reducing the long-term dependency on benefits and reducing their likelihood of offending. So it's jointly funded by 3 different government departments, the Department of Work and Pensions, the Central Cabinet Office and the Ministry of Justice. And it's requiring a financial contribution at the local level, at local authorities, encouraging joint commissioning. It really enables the focus on what works, which may sound obvious, but it's not just about government resources getting concentrated towards what works. We've also found that the service providers who are delivering the interventions are then very incentivised to focus on what works in delivery and then reorienting their approaches as they learn what is and what isn't working. And linked to that is Alex's point earlier around stimulating innovation and continuous improvement. This is probably what we found to be the most important benefit of outcomes commissioning, as I'm not sure there's really any such thing as a proven intervention. To give you an example, there's a model called multi-systemic therapy, which has strong evidence base in the US for reducing offending among young demographic. And it's actually got a randomized controlled trial that's statistically significant to back up the evidence on that. But there hasn't been a similar study, complete with control group, as to whether that same therapeutic model can divert people from care and going into institutional care. So allowing service providers to be entrepreneurial and flex their approach as they learn is what is making outcomes-based approach to commissioning compelling. We have taken that model in one of our social impact bonds and are applying it to work with children in care based on the evidence we have to see whether that's something that can work in the same instance. So there's an element of innovation there and there's an element of adaptation which I'll come back to as that programme is delivered. So it means that commissioning of public services can mimic what we've seen really effective entrepreneurial organisations do: learn, quickly adapt and continue innovating. And then finally on this slide, understanding results. It really forces us to understand whether we're achieving what we think we are. And not just in terms of outcomes, but in terms of impact, i.e. what would have happened otherwise, known as the counterfactual. And that's not present in all social impact bonds. In some instances, there's a strong enough argument, I won't go into the detail, but can in the questions if we want, on where it may not be applicable. but broadly speaking, you are looking for evidence as to what would have happened otherwise. And the intent of all of these benefits, when it's designed well, is to add up to increasing efficiency and effectiveness in delivering outcomes. So if you can go on to the next slide, Alex. Now, so far we've said nothing about social impact bonds. We've just been talking about outcomes-based commissioning. So where does the impact bond come in? Well, for an outcomes contract to become a SIB, a third party is introduced. So you've got the commissioner, you've got the service provider, and now you have a third party investor. Why? Well, because service providers might lack the strength of the balance sheet to manage the working capital, sometimes growth capital, required to get them from the start of the contract to the delivery of the outcomes, and therefore the income that is associated with the results delivered. They simply don't have the finance to get them from point A to point B. They might also lack experience in delivering outcomes-based contracts and therefore require more hands-on support to get them to those desired results. So since big established players, often for-profit organisations, can engage in outcomes contracts directly because they have a strong balance sheet, they have the working capital commitments, then social impact bonds can come into the picture when the delivery partners, perhaps those that are smaller, more localised, often social sector organisations, charities or social enterprises, who often have a really in-depth understanding of the target group that these impact bonds are trying to support. Now, when they want to bid for an outcomes contract, they need that finance externally. So what's so exciting about social impact bonds is, I think, their ability to level the playing field in who can bid for outcomes-based contracts. And given that outcomes-based contracts in the UK at least are at least 15 billion in terms of commissioning sterling, that perhaps offers an opportunity to socially driven organisations who may have the best, the most effective ideas at delivering services. It's also why we've seen many what you might call impact investors engage in social impact bonds. I saw that was a question earlier raised already on the webinar about who invested in the Peterborough model. Well, it was a mix of individuals, high net worths and foundations, and we've seen that in subsequent social impact bonds, but we've also seen more institutional investors start to get involved. So it's a real range of entities. I think it works where the investor understands the social issues, having often been outcomes buyers themselves, and they therefore understand the financial risk and return being taken on, as well as the social risk and return, which, if the outcomes contract is designed correctly, are aligned. So, next slide. SIBs are a way of getting smart capital to brilliant delivery organisations who couldn't otherwise compete for outcomes contracts, which, as I say, means that they can level the playing field and hopefully allow the best delivery partners to work on the programmes. But we hope that it goes beyond capital as well. Our sense is that with the right third-party investors who can bring oversight, delivery support, then they can add real value, stimulating that innovation and continuous improvement in order to drive better outcomes. Now, all of this, we've been talking about social impact bonds, equally applies to development impact bonds. The difference is that in a SIB, the central or the local government, so state entity, is acting as the commissioner, and in a development impact bond, the outcomes player is not a domestic government body, but it could be a foundation, a corporate entity, a development finance institution, perhaps. So we've seen one in Rajasthan, in India, where the Children's Investment Fund Foundation is paying for the outcomes, and you have another investor backing a service provider operating in Rajasthan as part of a DIB. So it's early days so far, roughly 50 globally I mentioned, 30 in the UK, so it's a relatively small proportion so far of the wider outcomes-based contracting market. But let me try and bring some of this to life with a case study, which is the next slide, Alex, with the Career Connect case study. So one from the Innovation Fund of the Department for Work and Pensions that I mentioned. Now this was developed by Triodos with Career Connect, in which the Bridges Social Impact Bond Fund invested in 2012. So if you look to the top right of this slide, the aim was to work with young people on Merseyside with a particular focus on ex-offenders, those in or leaving care, and those with learning difficulties, so a particularly vulnerable group at risk of dropping out of school, to help them improve their attendance and behaviour, achieve educational qualifications, and move on to further educational employment. The programme provided a wide range of support to young people of different ages, but it became quite clear early that earlier intervention at 14 to 16, rather than an older cohort, was the most effective approach. And Career Connect delivered a structured, what they call mental toughness course, for young people to re-engage in with education. If you look to the top right, you can see, I hope just about, it's quite small, but what we call a rate card, which with a price that was placed by the Department for Work and Pensions, this is public information, on what price they would put on achieving those results for the young people on the programs, up to a maximum possible amount, maximum payment per child, which is over 8,000. So it was capped out. And Career Connect, with the work that we were doing with them, offered a bid at 30% discount to this rate card for the first social impact bond. And as they got to know the program better, for the second impact bond, which we'll come on to, were able to drive the cost down further as they became more efficient and effective at what they were doing to a 50% discount, achieving, in a sense, better efficiency for the taxpayer in this instance. But we made quite a lot of changes to the program, and if we look at that in the bottom left-hand corner, as we went through it, as we learned, and as we were gathering the data on what was working and what wasn't working. We reoriented the program, we created a new course, we had to replace the performance manager and some of the subcontractors originally who were not delivering in line with expectations. So it's quite a hands-on model, but we think that that has really helped inform changes to the program, which led to improved results over time, which you can see in the bottom right, in terms of the percentages, the conversion rates improving from year 1 through to year 3. And I think importantly as well, this impact performance management can not just help the, obviously the delivery of the results, but has been valuable for the charity itself. We're all learning this is a different approach to grants, where funds are provided on activities, not outputs. But you can see from the quote there that a lot of the charities we're working with are commenting that the process of engaging in something like this has really improved their internal systems and had positive spillover effects for other programs, as you can see from that quote. But what's really exciting, to Alex's point about exit, beyond the most important result of the improved outcomes for these young people, is the recommissioning of the SIB, which has happened now. So it's exited, it's fully repaid investors, and it's been recommissioned by the Department for Work and Pensions, which has enabled Career Connect to bid at a greater discount, driving efficiency and effectiveness. So we're delighted to see the first instances of these models being recommissioned to continue working with vulnerable groups. If we flip on to the next slide, I might flip forward actually, I can always come back to another example, Alex. If you flip onto the last slide, just aware of time. So a few questions that I might, before we move to questions, I might pose some of my own questions. As I say, we're all learning in this process. I've spoken about the merits of outcomes-based commissioning and how SIBs work. They can level the playing field as well as add additional incentives for continuous improvement. But the series of steps I've described are prompted by outcomes commissioning, as well as adding costs of having investors at the table. It's no surprise that SIBs perhaps have been criticised as too complex and too costly. So while these initial ones have been perhaps expensive because everybody's learning, I do question whether when we say too costly, we're comparing them to the right yardstick. If you're comfortable with the status quo and the rates of children dropping out of school or going into institutional care or high rates of reoffending, then no, you wouldn't go through this process and the upheaval it requires. The question is whether we're happy with the status quo. I think this is the first question that society and commissioners should be asking when they're thinking about going down a route like this, and whether we think that a model can actually drive better results. I think actually I might stop there, Alex, rather than going to the next bit, so that we can move to questions. But thank you everybody for your time.
Thank you, Emilie and Alex. That was fantastic. We do have a number of questions that have been coming in, and I want to make sure that we've got enough time to answer them. Matthew, we are getting to your question. In terms of Alex, this is a question for you. Were the investors in the Peterborough pilot fully commercial, or did they come from a more traditional social impact heritage or from the nonprofit sector?
Hi, can you hear me? They were almost exclusively foundations investing out of their, I guess you'd call it mission-related investing portfolio. So it was not by any means a mainstream investment play at all. I think it was the first. It was, I'm sure, seen to be very risky, and I think the investors were really coming into this for the social impact outcomes, not the financial return. Although it needs to be said that I think without having the full details of all the contracts, the investors didn't lose out, even though the Peterborough SIB ended up finishing early. It was carefully structured, so if there were early, if it did finish early, the investors got a decent return. And the evidence on the performance of the SIB, such as it is today, it hasn't been complete yet in terms of the data analysis, is that it probably would return some money anyway to them on the basis of outcomes. But it wasn't by any means a mainstream play. And I think it takes something like in the Rikers Island SIB in New York City, you had Goldman Sachs as the investor really, which seems like a mainstream play. But in that case also that's a little bit misleading because it was a very substantial underwriting of their risk by Michael Bloomberg's personal philanthropic foundation to make sure that the downside risk for them was pretty low. It was kind of less than 30% of their money they were going to lose if it failed. So I think we're seeing, the risk of these, or the risk return profile of these SIBs having to be carefully managed at the moment to get mainstream players in.
That's great. We've got a question from Nikki, and it's really given the fact that there's been considerable government funding cuts in financing of renewable energy projects, how important and can the SIB tool be used in the area of energy renewal? Do you have illustrations of that? To either Emilie or Alex, yeah?
Question for Emilie, really. I don't think. Emilie, do you know of any?
Not so far, but I know there are organisations looking into this, organisations looking at, particularly in emerging markets, so less in the UK, but looking at connecting people on grid, for example. There's only one impact bond so far in the field of environment, which is looking at improving coffee and cocoa crop yields in Peru. But any model that has measurable outcomes within a relatively sort of 5 to 7 year time period of results being delivered with a clear potential to improve results, in theory at least, where there's a commissioner willing to pay, of course, is potentially open to outcomes-based commissioning and being invested in by an impact bond.
Fantastic. Okay, thank you. Gert has a question. What are currently the issue amounts of SIBs, and to what extent are pension funds investing? He's got multiple questions. Do these investments fit within their investment mandates?
Well, they're small, is what I would say. Emilie may be able to speak to the bigger investor universe. I mean, they're mostly small, kind of 5 million. In the case of Peterborough, I doubt all of that was drawn down in the end. Roughly $10 million in the Rikers Island. I think we're looking for the big plays to develop. I mean, these are probably, many of them, effectively pilots and trials. People are trying to find a way through SIBs, but I suppose in principle there's no reason why they shouldn't be at much bigger scale, particularly perhaps with the development impact bonds market, if you like, because I suppose development projects often work at kind of regional or even national scales. So I think as DIBs develop, assuming they do develop, they may be the first place when we see bigger plays. Pension funds, don't know the answer to that for sure. Emilie?
Yeah, so to your point, Alex, indeed, the average size is relatively small. I think the largest we've seen today in the US, they were tend to do things bigger, of course, was $25 million, but most have been below the 5 million mark. I think they tend to be done on an individual basis. As I mentioned, ours is the first fund to enable you to sort of then diversify the risk across a number of impact bond investments. But I think just because of the nascency of the market, obviously we're all watching the track record very carefully. And I think it could be that over time it does prove itself to be an attractive proposition for institutional investors, but that clearly depends on the track record and the structuring of some of these. We have seen more institutional investors become involved. We have a couple of pension funds in our social impact bond fund, for example. And we will see as that model develops. I mean, to go back to Alex's very first point, they are not bonds. And so you need to understand the risk-return characteristics of these models, and it's more, certainly more equity-like, I think, in the risk that it is being taken, because obviously in any individual bond, unless there's a layered financing structure, which we have seen in some in Australia and the US, then the investor stands to lose everything if the results are not delivered.
Great. We've got many questions, and I'm going to, for those of you who have posted questions and we don't have time to get answers, I'm going to ask Emilie and Alex to respond to your questions, and they'll be posted on our website. So a question from Zane. in terms of development bonds, more specifically microfinance, financial inclusion, social results bonds, what does the market look like and what are the challenges?
I'll hand that to you, Emily.
I'm not aware of any.
Oh, my.
Yeah, I'm not aware of any in the field of microfinance or providing access to finance, nor of any in development. There may be some, but I think there's quite a range of financial products already operational, of course, in the access to finance space. I suppose you've got to think about what are the outcomes. Would your outcomes be around increasing access for certain subgroups to finance? Would that be the result? Would that be the outcome? So not aware of thinking or development happening in that particular space.
Okay. In terms, this is from Ryan, what's the incentive for service providers to succeed? Reputational risk, or is there a financial benefit as well?
I mean, generally speaking, most service providers, I think there are maybe one or two exceptions, don't have, as it were, skin in the game. So I think there's maybe one or two, and Emily can correct me on this, where the service provider is also effectively an investor. So they have a financial upside to perform well. Otherwise, yes, I mean, I think the assumption here is that these organizations, broadly speaking, which have been working in these areas for some time, it is their mission to address whatever it is that the bond is trying to address. So there's some sense of them having every reason to want to maximize their impact. Yeah, and in the final scenario, there might be a reputational risk if they don't, for sure.
And these are being watched closely. I know that Goldman Sachs and Pritzker illustration of a SIB in Utah has been scrutinized heavily. At least it's been reported on the New York Times. Do you want to talk about some of the challenges in terms of outcome-based agenda and performance measures? Just how difficult it can be to capture what accurate numbers are, given the complexity of a social setting?
I mean, maybe I'd come in there to just say that's one of the big challenges of setting these up in the first place is the paucity of data and evidence for a lot of these social issues. You need to have an understanding of the existing problem, the scale of the challenge, and have accurate data to reflect that on which you can even begin to model the potential for better outcomes for that same group. And I've just come back from Madrid where we're discussing how these apply on the continent in Europe, and I think one of the big challenges coming from Italy, from Portugal, from Belgium, they're all saying the same things, that even getting the government data in the first place can be tricky in getting accurate data, and that's obviously the case in developing markets also. But I think it's a prize worth pursuing, and as I say, not just for social impact bonds, but to drive evidence-based commissioning more generally, and having this prize of having better results is one that I think we can all hopefully get behind. Whether or not that then actually results in a social impact bond, it can be a very valuable and instructive process, as mentioned.
Yeah, and this question is for you, Emily, and this will be our last question before we go into talking a little bit more about the program. What kind of level of return do private investors expect, and are these risk-adjusted returns?
So it's a range, which you may not be surprised to hear. I think when you're seeing some more of the programs that are being seen as pilots, then some of the investors, as I say, we're just looking at some in Europe just in the last couple of days, are really expecting return of principal, and so certainly not risk-adjusted returns. Others are looking at sort of single digits. The one in Belgium, for example, which is working with migrants, getting them into employment, is capped at a 6% return. I mean, it's sort of difficult to talk about returns, whether you're talking internal rate of return or the annualized, which we also need to overcome in these discussions. Others where the program is scaled and has quite a track record and they're just kind of expanding it like we've seen in the US, then it might be getting closer to double-digit returns that are sought. So it really is a range, and as I say, you've got these layered structures as well, so some might be stepping in with guarantees or first loss pieces to both enable upside and reduce downside for other investors. So you can really structure them in a number of different ways.
Fantastic. I think that the conversation that we've been having this morning, this afternoon, this evening, wherever you are in the world, is the kind of vibrant discussion that we have in the classroom. And Emily and Alex and I are part of the teaching team. And so this gives you, again, an illustration of the kinds of discussions that we have. I want to thank Emily and Alex for participating, and for those of you, again, who we've got lots of questions that are unanswered, if Alex and Emily can provide a response, we'll do so on our website, and I'm going to let Brad Peaston, our good colleague, help us understand how best to take advantage of technology. Alex, do you want to go to the next slide? Alex is master of the universe in terms of technology today. In addition to our webinar series, we also are offering podcasts, and we're going to be launching a whiteboard series where we'll be asking faculty to again, present cutting-edge ideas and research to allow you as a community of practice to better understand the opportunities in impact investing. We have 2 podcasts right now that are posted on our website. One is Arts and Impact Investing and Afro-Capitalism and Impact Investing. Upcoming webinars will be on Silicon Valley and technology, impact investing experience, performance measures, tools and strategies, and going to scale on carbon efficiency products for investors. Now those will take place in January, February, March of 2016. I want to turn the conversation over to Brad Peaston, who, next slide, Alex, and Brad, you're going to be up, to talk about the Oxford Impact Investing Program and how you can be more involved.
Great.
With that, Brad?
Great. Thank you very much, Gail, Alex, and Emily today. I really appreciate your insights on our Social Impact Bond webinar. But firstly, I just wanted to say thank you to everybody for taking time out of your busy diaries to be with us today to learn more about this very important and emerging topic, and for attending our Impact Investing Insight series. And as Gail mentioned, this is a series, so we will be continuing in the next year on some very topical issues. So I guess to go on to the program, we run a week-long impact investing program, as you can see, for aspiring social entrepreneurs, finance and investment professionals, those from development finance, international development, government, foundations, and corporates. I know that sounds like a very lengthy list, but one of the real strengths of our program is the fact that we bring very aspirational individuals and professionals from around the world into a very safe space to talk about their respective challenges in this area. So it's a massive strength having the full spectrum of impact investors in one place to discuss their alternative views in the area. And I'd also like to focus on one of the major USPs on the program that I believe is that each and every individual is able to work on their impact investing strategy and action plan, either from an organizational point of view or from their own aspirational individual perspective. So thank you very much for joining us. I really appreciate it.
Fantastic. We hope to see you soon.
And if you have any questions, please get in contact with me. Alex, if you could please flick to the next slide, I'd really appreciate that. So for any further questions, or if you would like a more soft touch, in-depth discussion with me over the phone, I'd be really happy to connect with you and to continue the discussion. So as you can see, my details are available, and please contact me at your convenience. And again, right. Thank you very much.
Thank you.
Oh my God. All right. It's all collapsed.
And Alex, I can see your slides.
Oh,
so
thank
you all.
Yeah. Okay, all right.
Right, so we'll call an end to today's session.
Sorry, I ruined it. Sorry.
No, that's Alex. It's fine. So again, thank you very much for joining us, and we will close today's session there. Look forward to speaking with you soon. Thank you very much for your time.